Zayn, I'm the managing partner of Sturgeon Capital. Effectively, we're a London-based venture firm managing just under 300 million, really focused on investing in what we call nascent venture ecosystem. So really it's the core of kind of frontier and emerging markets that are countries that really are early in their establishment of a VC ecosystem off the back of building that technology infrastructure. And so that includes countries like Pakistan, Bangladesh, MENA, especially Egypt, and as a region, Central Asia. And the sectors that we focus on really are across three areas. The first being fintech, both on the infrastructure payments layer, on the lending layer, B2B software, and marketplaces. And to date, we've made 5 investments in Pakistan. And actually, most recently have Saad Hassan join us as a local team member on the ground, which hopefully demonstrates our commitment to the country and our intention to be investing there for many years to come. So thank you for having me again.
Thank you for joining us. It's super having you both here. So a little bit for the audience about myself. My name is Maliha Bangash, and I've been working in the financial services, investment banking, corporate banking sector for more than almost 20 years, more than 20 years actually. And I have been a regulator as well. I was the founding member of the Competition Commission of Pakistan, and I was involved in writing the law and the regime for mergers and acquisitions and competition research for competitive practices. Other than that, I have also set up an asset management or investment management firm in Pakistan by the name of MCP Asset Management. I have been the deputy CEO of Habib Asset Management and the managing director of ICRU. So all different, which was World Bank Group's initiative, the Investment Climate Reform Unit. And most recently, I have been consulting with an international development investment firm based out of Singapore. So I have experience in Singapore. I have experience in Singapore, in Turkey, and mostly in Pakistan. And currently, I'm covering the markets of East Asia and Pacific, so the regional markets. So I'm working on specifically on digital banking. So there you go, technology again. It's in every aspect of our lives. So with that, I think we can start our session. It promises to be a very exciting one because of the tremendous experience that our panelists bring today. So starting with Faisal, I would like to really, capture and sort of delve into your very rich experience in Pakistan and beyond globally, and understand from you what you think super cycles are, and if you could give us and the audience an overview in your context about super cycles and how they play out in terms of the global environment and the economic environment. Thank you.
Sure, thank you. So I think it just depends on how you view the world. Different investment mandates require you to view from a different lens. So if you're a hedge fund and you have a short-term mandate, some investors are better making bets on a quarterly basis, on an annual basis. In the venture capital space, primarily all of us tend to be long-term investors, and we're attempting to predict the future. So let's say if we're investing today, we're trying to bet on the outcomes in sometime in 2030 or a little bit before that. So it forces us to have a very bird's eye view type of an assessment of where the future is headed. So for me personally, and I think a lot of economists, macro economists tend to, and I think Kian, who's on the panel today, he also has a similar type of understanding, which is long-term. It tends to come into a mechanism where history, it doesn't necessarily repeat, but it rhymes a lot. And when you look at basically long-term cycles, I go by credit cycles. So we're in something that, let's say a cycle that began in the 1980s, a very similar era prior to that we're living in currently, where if I were to break it down in the 70s, we had a supply side boycott of the consumer, which was basically the oil embargo. So very, very similar in that space. The US dollar at that time had just depegged from gold. And there was basically a free float in the market where basically you had for about 4 or 5 years, the only way to counter it was the Federal Reserve in the US started raising rates. Now, in that cycle, they took it all the way. In fact, they raised it at first in the 70s in the initial half until about, I think, 74, which is kind of what we just went through right now. And then inflation came down. And then again, they had to spike it again, rates. The second time they had to do it much more aggressively, took it all the way to 16%. I can't even imagine where the world would sit if they take it to 16% today. But if I had to compare these cycles more to, again, history, I think the world today looks a lot more like 1945 in terms of leverage and debt that exists on balance sheets of governments and corporations. Everybody's over leveraged in today's world, and a lot less like the 70s in terms of the 70s there was a lot less debt at the sovereign balance sheet, but the economic environment in the monetary cycle is very similar. So I don't think central banks have too much further to go. I think we're seeing about the peak rates of where the US is going to be. When I say peak, meaning they might raise another 50 basis points, 25 basis points over the next 2 cycles. But I think hopefully the 75 aggressive bips rise is gone. So that means that possibly the dollar is peaking at this time. So decimation we've seen over the last year, which has been pretty brutal, I think, if you look at even from 40 years, I think that's behind us, but that doesn't mean anyone's out of the water. I think 2023 is going to be a very tough year for frontier markets and emerging markets for sure, and most of the developed world as well. Probably the US will go into a recession, but a much milder recession than all of us are going to face in the rest of the world. So now the reason why I'm talking about all this is because, remember, and venture capital were long-term investors. So it does make a difference for our portfolio companies because the environment we're facing, we haven't seen these type of rates since almost 12 years, since I would say 2010, we haven't seen rates so high since prior to 2008. So it's effectively a very different environment for our portfolio companies to navigate. And especially in Pakistan, which is, if I were to break it down from a VC perspective, let's say if there's 5 dedicated funds for Pakistan, okay, what stage are they in their capital deployment? I would say most of them have either deployed 50% or more, and they've reserved dry powder for follow-ons. And then the other funds that are raising new funds, most of them are in their first closes. So there's some time to go before capital is available. And then everybody else was primarily opportunistic, but barring some funds like Sturgeon. Sturgeon actually has Pakistan within their mandate. But a lot of the larger funds out there were investing from the 10% opportunistic allocation, probably a fraction. I can assure you those guys are gone. They were only there in a risk-on environment when there was, everything was so priced up that Pakistan looked attractive. That's not coming back for at least, in my opinion, at least Q3 to Q2 of 2024, because everything around us has to come back to, at least prices have to look unattractive around Pakistan. So founders have to be really smart. They have to preserve capital, extend their runway. And in my personal opinion, the first half of 2023 is going to be far worse in terms of a number of companies shutting down that start to run out of capital. So that's what I'm fixated on. And by the way, from a cycle perspective, we're of course in a super cycle, but this super cycle is going to continue similar to the 70s this entire decade. And I think we're going to see possibly the economic cycles shrink, where we'll see basically rate cuts and hikes happen quicker, but we'll navigate that as that comes.
So you're saying that perhaps the super cycles are there, but they're shorter than they're sharper and shorter than what we experienced previously.
So if we looked at Pakistan in 2010, we had 10% inflation, right? Now our inflation is like in double digits, very high, right? But now when a developed market, especially the reserve currency market, is sitting at 9.1% inflation. And by the way, I don't believe that official number. I think the actual number is much higher since you're excluding food and energy, which is what impacts the consumer pocket. So if you think about that, that's the sign that we're at the tail end of a very big debt cycle, where everyone's over leveraged beyond belief. And so I think that their economic cycles are going to shrink, right? For this is the 7 to 10 years, the bandwidth for the central banks there to keep raising and then cutting to stimulate. I think they have to change that policy unless they come out with a new form of monetary policy, which is something that is a wild card with programmable money and potentially the digital dollar. But we'll get into that in some other discussion.
Sure. But that would be a very interesting discussion too, right? Yes. Yeah. So thank you for those insights. So it's interesting to hear the good and not so good news about how, it's going to pan out in terms of, how founders have to be careful and how we're at the tail end of perhaps a kind of a super cycle. And having said that, Kian, I'm going to just pull you into this discussion and ask you, based on, the very interesting insights that Faisal has given in terms of an overview for what is happening economically, and he's made the beautiful connections between, what is happening in the US and, the flow of capital and the opportunity and the rates and of course the dollar strengthening and the inflationary pressure and all of that. But now let's sort of home in onto perhaps your experience in the emerging markets and the frontier markets, and also understand what you have experienced and what you would like to add or have our audience know about unlocking true value of investments, and of course your experience with technology as well. So over to you now, Kian.
Sure. So from the first lens that I'll take it through is why we think there is kind of a confluence of factors that probably over the next 20, 30 years will entail basically significant value creation in the digital space in countries like Pakistan. And then two, to kind of transpose that with the realities that what Faisal has said based on kind of the experience that we've had. So if you want to define effectively what a super cycle is, it is a confluence of factors coming together to kind of create this dynamic of a secular tailwind playing out over an extended period of time.
Sure.
And then if you want to view it from a technology lens, effectively, if you think about technology evolution over the past 50 years, it's really been globally unevenly distributed, i.e. the developed world, which is a term I hate to use, but let's call it the Western world, has been the center of technology evolution. And for a whole host of factors, that hasn't been distributed across basically the world and the global population up until really the smartphone, right? So what you've seen over the past 10, 15 years is a handful of emerging markets. I mean, all emerging markets in some form or manner see smartphone penetration go from basically nothing to plus 50%, in some cases much higher, 70, 80%. What you've also seen is basically the advent of cloud computing, meaning that the combination of the distribution that's brought about through smartphones is also kind of coupled with the reality of compute power that otherwise wasn't available. And put together basically means that all the evolution and progress that you see on the technology side is now immediately attributable to all of these countries. And if you look at what's happened in more developed emerging markets, so let's take the likes of China, Latin America, Southeast Asia, what you basically saw was a rapid increase of technology companies building value in areas that were basically moving offline to online, but in a leapfrogging fashion, right? So in countries like Pakistan, you still have low single-digit e-commerce penetration. You have kind of low single-digit credit card penetration. The majority of payments are still offline. No real digital lending, and no real existence of B2B software. Our view is that basically over the next 20, 30 years, the fact that now you have this level of technology infrastructure means that you will have that unlock, that all these things will be built over the next 20, 30 years. If you add to that the globalization of venture as well, which I mean, will link to this liquidity argument, means that basically you have this confluence of factors that will allow this super cycle to play out. And it's not a novel concept. It's a concept that we've seen, as I've said, in more developed emerging markets. So if you look at China, basically from 1995 to now, they've created nearly $2.5 trillion in enterprise value. If you look at India, it's been over 100 billion. Indonesia, over 40 billion. Latin America, over 100 billion. So effectively, once you have that smartphone penetration or technology cat out the bag, it's very difficult to retrench from that position. So you have the baseline for things to be created. The question is how they're built and in what manner they're built. And the reality is that liquidity in VC also ebbs and flows in reality with what's going on in the rest of the world. It's kind of Faisal well articulated. The difference that technology and VC creates in markets like Pakistan is that finally you are able to invest in a secular trend. And the thesis does not rest on GDP growth. So actually going back nearly 7-8 years ago, started two companies in Iran, out of all places. And one was in the online auto space and one was in the online insurance space. If I take the auto space as an example, that's a market offline that does $20 billion a year in transaction value. Meaning what? Meaning even if, and those companies were built, I mean, that particular company was built to kind of a $70 million revenue business during two 80% currency devaluations. Right, a very difficult period, and a country effectively in recession. But the point was the quantum of the market size you were tackling was large enough that you would basically outgrow that. And actually, if your service or product you're providing is efficient and is something that people do consume on a day-to-day basis, even in difficult times, people move towards your service as opposed to move away from it, because you're not providing a discretionary service, you're providing a core service. Competition weakens, operating costs go down. The reality is to understand that when you're building a business in a frontier emerging market, you're building through cycles, and those cycles are much shorter. And so when you're calibrating runway, calibrating growth, thinking about all these things, you have to kind of understand the reality of what you're building against, but it doesn't take away from the larger, more broader opportunities that we see basically over the next 20, 30 years playing out.
So excellent, yeah. Great examples there about the auto and insurance industries and how, really through services and through addressing core, core services or core products, you can actually capture so much value and actually using and it's interesting how you brought in how distribution through these cloud-based services has made it's been a kind of an equalizer across markets, so there's no developing and underdeveloped and whatever markets, because you have access to these cloud-based services. And excellent insights over there. So going back to Faisal now, after those very interesting examples, and perhaps we'll also narrow in now a little bit, Faisal, onto your actual, experience with companies. You have been running VC funds. You're also a partner currently as well, not only a co-founder of Zayn Capital, but also you are a partner in is it BitRate or which is a fund that you are actually BitRate, yeah. So so I know that you've also been doing excellent work with Laxon Venture Capital, and also you were an executive director at MTV Pakistan. So you have very specific experiences. And I think that it would be very useful for our audience to understand from you, especially in the context of the more wider global lens that you wear now, and that you are experienced in a wider way now, that what were your learnings, in these specific perhaps roles that you played, or the Pakistan market investments that you did, because you were working more in perhaps early stage or growth stage, like you mentioned. And so there are two aspects. What do you think would be the key takeaways? What would you think the learnings would be? And in learnings, we also want to highlight what not to do, so what to do and what not to do from the investees' perspective, the startups, the investee firms, the growth firms that want investment, and also from the investors' perspective. So it would be very useful if you could throw some light on that. Thanks.
Sure. So I think Pakistan is a very unique country in the sense that it's a massive opportunity. And if you get things right in investments or any business here, it's a sure shot, effectively, ticket to generational wealth. But I think to get there, at least I'm a Pakistani American, and I moved back in 2017. One of the main lessons, and I've been investing in Pakistan in a personal capacity, as you mentioned, with MTV and also in other businesses, not necessarily tech, some are hybrid tech. You start to realize that you can't use your US biases of understanding controls and governance in a place like Pakistan, because there are no controls for collusion, for example, right? That exists quite prevalent in Pakistan. So that's one element. Then the other one is also the fact that.
So I would know that being in having worked in the competitive, competition commission. So collusion was a big thing we had to address. So sorry, please continue.
Exactly. No, absolutely. In fact, I think you were the one that approved my first investment in Pakistan at the CCP, Bookme.pk.
That's right.
So I just realized that when you mentioned that you were at the CCP. Now, that's one element, but the other one is that cycles here are very are different than developed markets. So in the US, if you have 90 days of a receivable, that's borderline write-off. In a country like Pakistan, or it goes in the allowance for doubtful account. In Pakistan, that's normal. I mean, 15 days is considered cash, right? So understanding those nuances of the overall system, the informal credit economy, and then the other one, and I think this was my biggest lesson, is that, and I see a lot of my peers in the US, especially, I think a lot of them made that mistake last year, and they ended up paying the price later on in terms of some of those companies very quickly deflating in value, is that I don't want to invest in somebody like me in Pakistan, because in terms of when I landed back in 2017, I would have lost my shirt. Actually, I did lose my shirt in some of the early businesses that I invested in Pakistan. And I would have literally lost my shirt if somebody gave me even $2 million and said, hey, go in and try to build a business. Because I think my office manager would have probably, managed to swindle like $50,000, $60,000 a month out of me, just because I wouldn't even understand pricing or how to deal with vendors in Pakistan.
That's true. That's true.
So generally, the people I find the best people to back in this country are generally the people that come from a middle income background, that aren't necessarily from very affluent backgrounds or haven't necessarily studied abroad or worked at McKinsey or any of the big brands abroad. That's not to say I'm discounting all of that. Some of those guys are really smart and have these attributes that I didn't have. But generally, you need people that one are hungry, that don't have a fallback in Pakistan. So they're going to give it their 200% to make this thing work. And the other component is they have to understand the local hustle, which is extremely difficult. I mean, some of the best founders we backed, they would stretch $1 million to $10 million equivalent in terms of what they were building, because they understood where the siphoning could happen, where whatnot, to put the domestic controls in place to manage the company with a team of 200, 300 people. So I think that was probably the most important learning curve for me in terms of who failed businesses early on in Pakistan and through just dealings in Pakistan. But overall, that's not to discount somebody that comes from abroad with experience. I mean, they have something that the local people don't, especially because people don't travel as much outside. A lot of foreign returned Pakistanis have a bird's eye view and a vision that the local founders don't. So to me, the best teams are where somebody that's returned from abroad partners with somebody that's been in Pakistan all throughout, and then they collectively build a company. And those have turned out to be some of the best companies in Pakistan, in fact, as we speak. So that would be the number one lesson. Governance is something that, like, for example, I'll give you an example. In Pakistan, last year, everybody started acting like this was Silicon Valley with 30 years of innovation and people understanding what's going on. There were safes that were signed and founders were like, we're not giving you a board seat. In fact, we don't even have a board. I mean, that is a recipe for a disaster for someone that's never managed cash flow and you're handling them significant chunks of cash. And then it's not misappropriations, but obviously it's, if a founder doesn't know his or her cash flow position on their fingertips, I can assure you they can't run a company. And I saw a lot of that happening. So I think it's also making sure that governance in these type of countries, especially new, and when I say these type of countries, nascent ecosystems, these are the guys that are going to train the next generation of founders also. So it's putting that right governance control in place and, being a soundboard, not controlling them, but being a soundboard and giving them guidance to build best practices. Remember, most of our investing are investing in venture capital in Pakistan, and why more money has come in VC in Pakistan than private equity. It's a lot easier to do greenfield projects here and set the ethos from the first day versus coming into companies in a mid-stage or pre-IPO and then trying to change the culture, which is impossible, where everybody in Pakistan has two sets of books. We're trying to make sure that doesn't happen right from the beginning in these startups. So the very, very basic lessons, they seem very intuitive, but in the heat of investments, many times, even I sometimes forget this, and then I slap myself around. I'm like, wait a minute, you need to make sure you're attending board meetings and asking these guys what's up, right? So it's a very, very, very small thing, but I think it works when you look at it in Pakistan like that.
So great insights there, Faisal. Sort of marrying international perspective with the local expertise was one key element for investors to be looking at. Someone like yourself would think that that would be the ideal match. So if founders who can do that, who can create a team where there's both of those elements represented, I think they have a greater chance of attracting the capital and also making a success of it. Also, you spoke about governance and, having a perspective as an investor to be actually involved enough so that you can not controlling, but guiding perhaps and ensuring that the governance is in place from the start early on so that it doesn't later on snowball into something that can't be controlled, and having a certain amount of knowledge for the founders to have knowledge about how to expend the funds and how to perhaps, plan and strategize and have along with the governance, and for the investors to be as kind of a sounding board, which is what you said was, I think, an excellent point, because I think sometimes that is missing, and that could add a lot of value to the work that the founders are doing and the investing company is doing. The fantastic insights and learnings that we have, received from Faisal. And now I'd like to take the conversation again to Kian and ask him about a little bit about, how, you can sort of leverage technology and how companies can, sort of leapfrog into the next level in his mind and from his perspective. So Kian, what do you think is critical for companies in emerging markets, as you've seen a lot of infrastructure and ecosystem develop in emerging markets or developing markets, and how can technology play a part in that? And what would you think are the key sort of learnings that you have for successful companies and successful investees that you have invested in? Thank you.
So maybe to start on the second point, and I guess to build on what Faisal is saying, I think the trap that probably a lot of emerging markets and maybe Pakistan to an extent fell into when it came to the VC ecosystem was to think that it's kind of one for one similar to Silicon Valley, i.e. Raise a lot of capital, blitz scale, et cetera, et cetera. But the reality is it takes a bit of a longer time to build a business in a market like Pakistan, especially when it's in its nascency. And there's this temptation to want to raise money at ever higher valuations because it feels good, makes you look good. But the reality is a high valuation effectively sets the expectation for what you have to achieve. The higher it is, the tight kind of the tighter the tightrope that you have to walk, and the lower the margin of error you have.
Absolutely.
And especially in early stage business, you need slack. Because if you look at the market, if you look at any of these type of markets, it's clear what the opportunity set is. There isn't a debate that if you build this business, it will be successful. It's just how and the manner you go about doing so. The other dynamic that's probably different from the US or Europe is the lack. I mean, there is competition, but it's not extremely intense competition where you have many well-funded players where if you slow down growth, someone else will come and take market share away from you. Meaning, there's no one has put a gun to anyone's head, and no investor should put a gun to a company's head to say you have to grow 5, 10x year on year. It's perfectly reasonably fine to grow 2x, 3x year on year, but kind of slowly build up that business, because a company that grows 5, 10x year on year, it's very likely that at some point it'll have system failure. Because think about it, you're doubling or tripling your workforce every year. If you have an offline operations to your business, that basically is growing at a rapid pace. And if you don't, going back to Faisal, but if you don't have the governance and systems that can kind of scale with that growth, it's inevitable that you'll have a break at some point in time.
Yes.
Not because you have bad intentions, but it's just the system will evolve in that way.
Yes.
And so really being thoughtful about the manner and the speed and the tempo with which you build your business, I think is really important when it comes to these country. So I'll take an esoteric example. If you look at a company called Kaspi in Kazakhstan, it took them probably 15 years to build that business during 250% devaluations, during many different cycles. But today it's a $12 billion business and a population of 18 million. They have half the country's population that use that application on a monthly basis. 1/3 of it use it on a daily basis. So there is a whole argument to be had as to the manner with which you build businesses. Going back to your first point, I think the most interesting thing when thinking about markets like Pakistan is this concept of distribution and how kind of smartphone penetration changes the nature of distribution. Because if you think about it, in the apps, the only companies in these markets that really have distribution in the millions are telecom operators. And they seemingly have kind of varied success in their ability to really monetize that user base. But with the advent of smartphones and kind of once it gets to a certain level of penetration and mass, it basically means you have significant scalability with the means of which you can distribute your product or service. And then if you think about that in the concept of bundling, unbundling, generally these markets are unbundled market, i.e. the service provision is fragmented. And there's a high correlation between your ability to bundle services on top of this kind of mass distribution. So you have this phenomenon in emerging markets, which you really don't have in developed markets yet, of this concept of super apps. And that's based off of that concept where what is the means of which you can build significant distribution, let's say sub $10 customer acquisition costs, and over time bundle up more and more services at marginal customer acquisition costs to go deeper into share of wallet, whether it's a consumer or SME, to basically serve a lot of what they would require on a day-to-day basis through one platform as opposed to a fragmented base. So that's one nuance of emerging or frontier markets that I think is quite fascinating, that is probably underappreciated.
Yes, thank you, Kian. I think that's very, very interesting because you're speaking to talk about the last bit first. You were speaking about the distribution aspect of it and how these various service layers can actually, help you capture a lot of value. And you also spoke very rightly about, connecting to what Faisal was saying about sometimes, how so much emphasis is being made on speed to market and so many X growth, because, perhaps there is a push for valuation and, for creating that perception of greater valuation and then pulling in some more money. But actually that might be a self sort of defeating sort of prophecy, because it will actually create a sort of a void or a lag between the kind of growth that you are doing and the ability or the capacity built in terms of systems, in terms of governance, in terms of the kind of people you have, or even developing the technology behind it. So you're trying to chase the X, but actually that can be something that can create a downfall. And I think the robustness is what you emphasized here. Of the growth, and then once the robustness and pacing it, really, creating a rhythm, pacing it, and ensuring that as you grow, the capacity to grow is there. It's sort of all in sync. And I think that also ties into what Faisal was talking about earlier, that founders have to only the robust will survive, because he's also expecting earlier on in the conversation, he was talking about how 2024 will have a kind of a shakeout, and not many of the initial companies, at least in the Pakistan market, or maybe even internationally, will be able to survive that shakeout because they will be missing some of the elements that you so rightly pointed out, Kian. So very, very interesting. I think tremendous wealth of knowledge and experience that we have drawn from Faisal and Kian. And so it is really, really great that we had this opportunity to have a chat with both of you. Thank you so much. I think that now we would really like to hear from the audience if there are any questions. Please, I would welcome audience questions, and then perhaps we can address them to Faisal and to Kian as per. the requirement or as per the subject matter. So Ali, is there, would you like to ask the questions, or would you like me to
I think in the
ask
chat, there's a couple of questions.
Sure. So maybe we can just read some questions off the chat. We can just take the first questions. So I'll just scroll up, and so first of all, what happens? There's a question which is, what happens if an emerging market defaults? What does that mean for a VC startup, and how do super cycles relate to that? So maybe I'll ask Faisal if you'd like to go first, and then we can have Kian's insights to it.
I think this is that question that keeps me up at night, because I think the first thing that'll happen, my fund blows up and LPs don't honor the commitment.
This is the nightmare. This is the nightmare.
Yeah, this is the nuclear scenario. I know it sounds like it's, look, so I mean, I'll give you some stats right now. I think out of the 73 emerging and frontier market, out of the debt like countries out there, almost about 25% of them are distressed. Their debt actually traded in public markets, right? That's a major issue. This was expected. You have to think of the Fed as raising interest rates as effectively like a wrecking ball, right? When they raise rates, it's like a magnet. The US dollar 10-year treasury is the replacement of gold in our system. So as they raise rates, the dollar scarcity kicks in, and you start to see most of the debt's been priced in dollars for most of these countries. And so then the country devalues, and it's like a cycle. People in the country panic. They basically run to the dollar as a safe haven. Like there's further devaluation unless you have really good
the vicious or virtuous cycle, depending on where you're at, which side you're at.
Exactly. And so and the dollar has to do this, right? So think of the dollar, like at the end of the day, the reserve currency, they do the strongest superpower in the world. When they keep printing repeatedly, eventually that dollar, which is a stick, turns into a bamboo stick, and then they have to raise rates to make it back into a kind of effectively remind us that they're the reserve currency, right? And right now, everywhere you go, if we default, which I don't think we're going to, because we'll find either strategic partners that will park money in Pakistan, because we're a very important country as a nuclear state. The world is betting. I mean, these are again like hopium combined with facts, but you have to realize that the world in 2008, the BRICS, after the 2008 GFC, the BRICS, and particularly China, grew the world out of the crisis. We need growth.
Yes.
It's a deep event.
Yes.
In 2000.
So it's not a pipe dream. It's not a pipe dream.
It's not a pipe dream. So now look, everybody, at least in the West, is betting on India's growth. That is their number one target for the next 5 years. India is going to grow the world out of this crisis. And then the rest of us.
China, and you know, the sort of an equalizing factor in this sort of geopolitical.
China's much further along in the credit cycle. So India, people see as a bigger growth opportunity, along with the next 11, like Indonesia, Pakistan, and everybody, right? But you know, if Pakistan defaults as a nuclear state, there's a massive destabilization effect, which then spills over to India. We're officially 220, but that's underreporting on the census. We're at least 250 million people. It's human nature. We've seen this play out in Syria, in Libya, in all these countries. Iraq, people will have to move on land, right? So the world can't afford that. Our debt is pittance when you compare it to I'll refer to what Kian said earlier. This is part of my thesis as well. You cannot use GDP as a measure of growth in these economies. What he was referring to is the reason why we're all investing in Pakistan is the unlocking of the informal economy, which in my opinion is at least 100% more. So we're probably a $600 billion to an $800 billion economy. So our current 80% debt to GDP ratio is probably closer to 40% if that gets unlocked by tech. I call it digital documentation, right? Because once you order something on Foodpanda, for example, even if you're settling in cash,
you're documented. You're on.
Good luck trying to prove later on when this data is interconnected, when your declared income is like $100 a month and your food bill is $1,000 a month, right?
Yeah. So we'll have the data to prove you wrong. Yeah.
Exactly. So look, I don't think the world is so I mean, I think that generally all the smart superpowers in the world that are digital superpowers today, they understand this equation. This is really a geopolitical event. It's about, are the Saudis and the GCC, the largest buyer is China. Are they flipping to that side and starting to settle somewhat in the renminbi energy bond? Not even renminbi. They have an energy bond that's settled. So is it 10% goes there or left or right? And then Pakistan's that middle ground. So if you ignore the noise, the chances in the documented GDP financial system analysis, we are in a pretty tough situation. $32 billion has to be refinanced next year. In reality, I've done the analysis. 15 billion is the real one. Most of that is like government to government, that'll be restructured very easily. The commercial one is the Euro bonds. The government has already earmarked $1.5 billion for it. There's a remaining $4.5 billion of commercial debt that they do need to identify money for. The rest of the 9 billion will get restructured as well. That's bilateral and multilateral. So it's not that bad. I think our newspapers and the local WhatsApp community starts circulating stuff. I can't comment on fiscal and monetary policies that are suicidal, because in reality, that's exactly what's played out, right? I'm apolitical, but literally coming and trying to control the free market, and your spread goes from 10 rupees from the banking rate to the open market and then to 30 rupees. You're setting yourself up for a snap where basically effectively your remittances have dropped because sorry, excuse my language, but it's like only an idiot would wire money through official channels, and you're getting a rate of 224 to the dollar when the open market is sitting at 250 to 260. So effectively there's offline settlements happening now, right? Where people are giving people money and they're settling it in rupees and Pakistan. So unfortunately that is there. I don't think we default, but if we do default, you won't see me in a panel here in the future. I'll be driving an Uber in Dubai or something.
So we'll be looking for Faisal if that ever eventuality comes. But good to know that we are not going to go that route. And I will just chime in here with what Faisal is saying, that it's all economics. It's supply and demand, and nothing, whether it's the dollar rate or whatever you are trying to do, nothing in the economy can be artificially. So, just a general comment here, but Kian, any views on that?
No, I mean, I don't have such a critical insight on the economic side as Faisal had, but as he says, the quantum of kind of the debt outstanding in the global scheme of things is not terribly high that it cannot be restructured or solved in some formal manner. So probably the probability of a default is, I mean, not low, but not super high. I think actually it pays to look at the experience of Latin America in this regard. I mean, there you have a country, Argentina, that has a record of the
Argentina that went into default.
Years.
Yeah.
It also has a similar narrative of kind of a handful of countries that hold a lot of promise but have never really delivered on it. But at the same time, over the past 10 years, you've just seen the proliferation of kind of quite large and successful technology companies there. And if you look at Brazil during 2014 and 17, you had the height of political instability and the height of economic instability. Yet those were the years where
they're correlated, actually. Kian, unfortunately, they're correlated. Yeah.
Yeah, they're joined at the hip. But you had companies like Nubank and Mercado Libre to reform. That's not to say that to have this naive, arbitrary view of in any environment. No, it's difficulty levels just increase significantly. It doesn't mean that value cannot be created. It just means that the talent and wherewithal of the founders has to be much higher. And the opportunity set that they're working on has to have a real use case. It cannot be edge cases where it's a nice to have and must be a must to have.
It has to be a must to have and not a nice to have. I think that's a good way of putting it. There's another question, and I'll read it out. Are there any aspects that you would consider unprecedented in the current economic condition worldwide, and especially frontier markets like Pakistan? Maybe we can start with Kian, and then I'll have Faisal give his views.
Well, the starting point is unprecedented in the sense that, in the original point that I mentioned, you haven't had venture globalized in the way that it has been over the past few years ever, really. It's really kind of a past 10-year phenomenon. And the dynamics from that the dynamics from that starting point and how that evolves is kind of the interesting question. What you've seen in countries like Pakistan and others is that local ecosystems form, and their sources of capital are from kind of, let's say, local entrepreneurs, regional kind of family offices. It's what happens to that source of capital, and where does liquidity actually come from for the startup ecosystem, especially in early stage companies. Effectively, the oxygen is that liquidity.
Yes.
So that's so you have this, that's what's unprecedented in terms of your starting point. But having said that, you're again coming from a very low base. And there's actually
that's true. That's the low base effect also. Yeah, absolutely.
Correct. And going to my point of building businesses relative to the reality of these markets, there was a great article by this gentleman called Lazaro called it, "When it comes to emerging markets, you have to build camels, not unicorns." Again.
Oh wow! Same thing. Yeah.
Yeah, recognizing that there's this concept that there's inherent volatility, there's inherent instability. But what you're doing is digitalizing the stock of GDP, not the flow of GDP. And you have to build companies versus that reality. It means that from the very early stage, if in, for example, in the West, you could get away with a Series A company where your unit economics aren't clear, they have to be damn clear even at seed stage. Your kind of loss curve is just much less. So again, it goes back to that point. It makes the opportunity set more difficult, but doesn't negate the opportunity set. It just makes founders have to navigate them much better.
Yeah, great point. So camels, not unicorns. Faisal, any views, any thoughts to add?
By the way, I agree with that. I don't think we're going to have too many unicorns in Pakistan. A lot of companies are going to top out at like $200, $300 million, but that's great returns if you come in at a pre-seed. Now, in terms of, in terms of, I guess I'll address what's different about this cycle worldwide is that, look, I view this cycle as the monetary system cycle. And again, I keep mentioning 1971. If you do the math from 71 till 2021, that's 50 years. The Fed had a target inflation rate of 2%. That's 2% debasement. Effectively, 100% of our monetary system's value has been extracted. So now we're basically on the life support system of the Federal Reserve monetary policy. So going forward, I believe we're going to enter at some point this decade a new monetary system, more than likely led by the digital dollar, which is just basically a new type of dollar, or possibly the IMF SDR token. But it is definitely going to be crypto in its nature for digital settlements, not necessarily Bitcoin or the FTX token for sure. That we can confirm. But meaning something like that, right? So what does that do? Why is that so special for countries like Pakistan? Again, I'll go back to the informal economy. It is, once you go cashless, it is impossible to hide your assets in these countries, right? So let's go through all our problems, whether it's bribes or whatever. Good luck identifying your source of funds for bribes on a monthly basis if it's all coming in cashless, right? So I think what's special about this cycle is that at the end of the light at the end of the tunnel, in my opinion, is massive growth through tech. And again, digital payments is tech as well, right? We're adopting tech in the monetary system for the first time. So cash becomes documented. That's going to change, in my opinion, it's a leapfrogging effect, as Kian was mentioning earlier, that not only are the platform plays documenting this thing, but then the regulatory forces from FATF to OECD Common Reporting Standards are all driving factors that are pushing countries to adopt traceability. And that effectively, whenever that culminates, whether it's 5 years, 10 years, 15, it's going to be, in my opinion, it's going to be a very phenomenal leapfrogging effect for these countries. Hopefully our debt hasn't compounded to like 50x from here, so that by the time we're documenting, we're just basically matching the debt. But I think it's the light at the end of the tunnel is quite nice if we get to that. So very different cycle.
Maybe to add one point on that dynamic, and kind of when you look at countries through the lens of the if you believe generally that capitalism is the most efficient source allocation of resources and most efficient system for the allocation of resources and capital, and then look at emerging markets and through the lens of no judgment, but see the evolution of capitalism within them. What you find is that basically, and I don't say this for judgment, it's for no fault, is that basically to a large extent they've had the public sector, which has been the largest allocator of resources and capital. If you think about what technology inherently does, it replaces the government over time to be the most efficient allocator of resources and capital. And so you play that out over 20, 30 years, you basically you take market share away from the government and you reduce friction and increase efficiency basically across economies. That I think will be the game changer for countries like Pakistan and broadly more emerging markets, because you bring the full force of entrepreneurialism, the full force of capitalism to the most efficient means, i.e. technology, to bring the services and products that people need on a day-to-day basis in the most efficient means. The best idea wins, the best companies win, and you just have a more overall efficient system.
The best kind of meritocracy will happen when technology is accessible, and like you said, that's a fantastic thought and idea, and I can't agree with it more, that when the highest level of efficiency and productivity will happen when technology is there, accessible and as an effective tool, and which also talks about the ecosystem aspect of it that you spoke about, and Faisal in various ways spoke about, is that to develop that ecosystem where technology can actually distribute and deliver those services and those products. So fantastic, great discussion, and thank you both for these excellent insights. I believe we don't have any more questions. Ali, if you want to chime in and say anything, please do. If not, I think we are done for this evening, this afternoon, and this morning for all the various time zones. And with that, Ali, anything from you? Nothing, I think. So,
okay, ma'am.
Sure.
I think I can just read really quickly and I can type the next one.
Okay.
What can Pakistani startup ecosystem learn from the Indian ecosystem? Because they got 100 plus unicorns.
Yeah. I think that's a great question. So what learnings, what can we learn from the Indian ecosystem? And I think both of you would have great insights from there. So please, if you'd like to go first, Faisal, and then we'll go to Kian.
Sure. I mean, I think India is our closest comparable in terms of as a market, right? In terms of we're both former British colonies, very similar culture, similar some of the similar patterns as I was saying with collusion and all that stuff. But India has had some of the best founders. I think to me, Pakistan, that's how I pitch my fund. Pakistan's a mini India. All the attributes of India, whether it's a strong expat community in terms of in big tech, in finance, in not just in banking, in hedge funds and private equity funds, and some of the top tier Pakistanis are there. So Pakistani expat alumni are extremely have a lot of experience. They're well off. They will drive, eventually more and more people will move back and build companies in each wave. So that's been a strong point for India in terms of how they've played out. Plus the consumer market is very similar. Our size is 250 million. So if the only thing I would treat differently than India is that the world believing we're mini India, because their macros, remember they sacrificed for many years as a country, right? They were a closed country. They allowed their industries to develop. And now today, they're in a much stronger position from that point of view. So I think the only thing we have to be cognizant of is not to emulate or just read stories. I know Twitter is great, but it's simply like reading somebody's experience in a market with different factors and then saying that's the Bible philosophy for me to, as a founder, can backfire quite a bit. So I would look at them. I would look at ideas that have worked there culturally from a product market fit and then apply them to the local use case, keeping in mind local timing and dynamics. And I think that's a winning strategy. I would encourage everyone to look at India, read about India, and that's what I do. I mean, I actually look at India as the closest comparable to Pakistan, not MENA or not Southeast Asia.
Yeah, so but not do it blindly is what you're saying, and look at it in a context of Pakistan and what would work, and perhaps also the stage or the phase we're in, which is also something you highlighted. So yes, Kian, any thoughts?
No, just to echo both points. I mean, there's so many comparables to the markets. I mean, there isn't a one-for-one you could ever take. There are kind of principles of what works well in that market that you could think about when it comes to Pakistan. But at the end of the day, the execution has to be local. what I think Pakistan just needs is time. It has the talent, it has a diaspora that's kind of, it has the community, it has the ecosystem that's forming. It just needs time. And actually, I would say, kind of ecosystems like Pax Launch are the best catalyst for accelerating that time and for it to come to fruition.
Yeah, so the next question, I'll just read it out quickly. And the question is, after every down cycle, there's usually a change in what Ray Dalio would call a world order. So we're seeing a change in the world order. So if the VC cycle is looking at 2030, what will the world look like then? And what are your thoughts on how a decentralization is going to play out? Further, are we really trying to predict what will happen in 2030, or if it's even possible, or is the VC industry, which really hasn't seen many cycles as it's in its infancy, even globally, just going to be going by the liquidity available in the market? If available, deploy. If not available, sit out. So yeah, so it's a rather longish comment plus question. So it would be, any thoughts on that would be welcome. So VC, Faisal, what do you think?
I think it's a great question. Look, I think it is impossible to predict the future, obviously, right? But I think it depends on, I use very harsh terminology, so I'm going to say it depends on how hypnotized you are, right? So if you're hypnotized to think short term, and it's like it's like I told somebody in 2010, hey, by the way, gold is low, you might want to build a position in gold. Eventually, gold will rise when inflation kicks in. And then I got dinged because a week later, gold didn't go up, right? So these are like, it's how it comes down to how long-term you think. So if you're fixated on 2030, chances are you won't get it right, obviously 100%, but even if get it right by 5%, that will probably be, better than 99% of the people that may be thinking short-term. So yes, from trying to predict the future, if you think about it, I mean, that's how great companies were built, right? There were founders like whether you look at Jeff Bezos even, they saw things happening 20 years later, and they tried to build a product for the world 10 years later, 20 years later. And many failed and many succeeded. I do think that from a changing world order, I think that's pretty visible to most people now. If you don't see, if in my world, at least when I see Russia declaring a gold standard by basically saying 5,000 rubles is, I think, a gram of gold, that is effectively the quintessential sign of a changing world order. Not necessarily means that Russia has won. That just means that somebody is questioning the monetary system. And that would make me a little concerned that we're entering that phase now where I think that things will start to change very rapidly. If I had to, again, attempt to speculatively predict how the world would look like, I think it'll be a world dominated by the US and China. I think Europe is going to be in a deflationary event for the rest of this decade, probably. And they also have a demographic issue. But I think I would never short the US. I think the US they've got all the attributes there. They're leaders in tech, they're landmass, food security, every aspect of it is there as for the American digital empire. And the Chinese, I think, are very strong if they can make it through the next 2 years, because they are up against effectively equivalent to the GFC that the US faced in 2008. They have a lot of internal issues. But if they can pull off their long-term 50-year plan, I think that's the two-tiered world that potentially could be split in two. And that's what I was alluding to, the two monetary systems. One could be the Chinese-backed IMF token, where the renminbi is actually in that IMF SDR basket. And the other would be the digital dollar. And you can see those alliances naturally.
Yes.
I think that's what the battle in Pakistan is today. Which token side flipping to. But that's it. I mean, again, that's the bet. VC, I think, will be, again, going back to Kiran's point, I don't think we've ever had, I mean, VC was very nascent in the 70s, 80s, 90s, 2000s. Yep. If you look, I mean, really the internet launched in the current phase was 2000. 2000 is the acceleration point, right? So if you look at this entire equation, I mean, we're really in just the first 20 years of the internet. And this would be, if I had to compare this, I would say most of us investing right now are investing in Rockefeller's pipeline and Vanderbilt's railway, which were the rails of the Industrial Revolution. So, but time has been compressed because velocity is 15x in tech. Everything moves so fast. So I do think that probably 2030 would be closer to 1945, 1950s, in the sense that adoption over the next 10 years, just like World War I and II mechanization took place, the same thing is going to happen at a very rapid pace. But again, it's very speculative, obviously. I could be entirely wrong. But yeah, that's my belief personally.
So great parallel you're drawing with the early industrialization super cycle and what's happening now, and then compressing it due to the technology and the growth multiples that we're experiencing very fast. And also you're saying that there's, China and US are here to stay. So 2030, they're very much, on the horizon for you, the way you are looking at it. And also you're saying something which I want to sort of echo and concur. As an investment professional, I've done this almost all my professional career. I have looked at fundamental value, and robustness, which Kian was also talking about, in cash flows, ability to manage cash flows, and so all these factors. So I think any company or VC funds that are able to capture that aspect will then, of course, grow and get the value by 2030. Now, I think I'm going to ask Kian to look into his crystal ball and tell us what he sees in 2030.
Yeah, unfortunately, I'm not Mystic Meg. I think, look, if you look at the history of basically just capitalism over the past 100 years, is whenever capital can be combined with good ideas and good execution, value gets created. I think just kind of that as a simple principle is very difficult to negate. And at the job, there's a lot of things that I could theorize over. But my job principally is to back great founders, building great businesses in important areas, and try to support them as much as possible doing so. That's the thing that I can control. I think going back to the world order thing, I think what's interesting is if you look at every cycle, so what actually happens is an acceleration of bringing what is inevitable quicker to a certain point in time. So what was the dot-com boom? It was basically saying the internet to a large extent will transform the way the developed market functions. But rather than it playing out over a period of time, it accelerates over a 1-2 year period. And you have a supply-demand imbalance. And as a result, you had the kind of bust, right? 2008 was this concept that house prices will just kind of iteratively go up consistently, and the whole financial system being built off the function of that. Again, not to say that house prices don't iteratively go up over an extended period of time, but to fast forward that over a kind of a compressed period of time creates a supply-demand imbalance. And I think the same dynamic has played out in VC basically over the past 5 years. Yes, on a global basis, technology will really transform the way economies function, especially in emerging markets where kind of inefficiency is typically highest. But it's not going to happen in 2 to 3 years. It takes quite a while to play out. So my bet is basically in 2030, you will see a meaningful, significantly more amount of technology companies in countries like Pakistan, in Bangladesh, in the emerging markets. But they will play out, and those that earn the right to win will win, and those that earn the right to lose will lose. That's the way that I see it.
Sure, certainly. Great insights there. Yeah. So those who earn the right to win will win, and those who don't will lose. And that is the inevitability of the VC fund and the VC industry, because inevitably what happens is that there is a risk, involved in the capital that you are investing, and in the and that premium of that risk is really the multiple and the valuations that are going up eventually. So when you take that risk, the reward is higher, but of course the downside is also there. So going back to the chat and seeing what we have here, I think there's a last comment or question which says, most of the startups that are emerging in emerging markets are consumer or business services. How is the situation with respect to Web 3.0 related startups in Pakistan and other emerging markets? what are the key enablers for such startups? So, I can, it's open, whoever wants to take this question. Kian, would you like to go first?
I think it has to be Faisal. Runs the BitRate.
Okay, Faisal, I think this has to be
you. So I think, yes, Web 3.0 is very important. It is, I think all of us, I think including Kian, will be investing in Web 3.0 in about 5-6 years, maybe fund for me. Not right now. I'm only interested in this is a protocol level change. So I think building like the things on blockchain effectively is just a slower database. So I don't really, and that's why I wouldn't invest in something like an FTX, for example, right? Coinbase, yes, because the investors there and regulation is pretty tight. I'm even scared of Binance to some extent. But overall, I don't think the crypto ecosystem, it's kind of like what Kian was saying about the .com bubble. The demand is there for blockchain and effectively that is the future of the internet. It's the back-end infrastructure chain in the internet, but everybody priced in something that it way outpaced the demand, and that was a bubble. Crypto looked exactly like the .com bubble in 2021, and it's literally deflating like the same way. So today I would only invest in things like Bitcoin or in possibly even Ethereum. I think Ethereum is even risky because it's like an operating system, so there's other competitors. But in 5 years or so, absolutely. I think once you've shaken out all these 10,000 projects that most of them don't have a use case, you will actually have real use cases and all sorts of things in identity verification, tokenization of real estate they're very realistic cases. I just don't think the demand is there today. And I think it's definitely there in my thesis. And whenever if I end up doing a future fund in 2026, if I'm around by then, if we haven't defaulted, then I would obviously look for basically.
Which anyway, we're not defaulting. Which we are not defaulting, Faisal. You've already said that.
But I'll
so no questions.
I'd love to get his take on it too, because I've had value.
Yeah, sure.
I'd love to hear.
Sure.
No, it largely echoes yours. I mean, as you said, it's basically you've had this bubble form where so many things that are being built where there's kind of some level of traction, but it's kind of the real use case is quite questionable. And it's kind of culminated in this event of FTX that I think kind of has brought reality to the market. What I think implicitly the technology provides is the ability to rewire a lot of key pieces of infrastructure that things can then be built on top of. Now, how that plays out and how that's formed is kind of an open question. I actually was in Oman recently and I met this company that I found fascinating. What they were doing was working with different ministries in the country to move all of their data and infrastructure onto blockchain. So for example, the Justice Ministry, all the judicial records, they had moved on chain. With the Housing Ministry, effectively all of the housing records, they were moving it for them on chain. And sometimes it takes the governments to have that initiative to build that base layer of infrastructure, similar to kind of UPI in India or for payments, to then create a true ecosystem for things to be built on top of. But that's really the core use case as it stands today, is moving infrastructure on chain to then build on top of that, rather than kind of nice games here and there, which are maybe good ways to make money in the short term, but really don't have a kind of long-term use case. So as and when those kind of opportunities arise, we would look at it very seriously. But I think that's really the use case that has to be built.
Yeah, so great point. I think that, governments have the kind of database and the will and perhaps even the wherewithal to actually get stuff on blockchain and, convert it and then perhaps start that process. But clearly that's not where we're at. And that goes back to what Faisal was saying, that maybe the time is not there yet. Since you have been recently in Oman, Kian, and there's a question about Saudi. Perhaps you would like to answer it. Let me read it out. Saudi Arabia has Vision 2030 with a lot of giga projects, and we have very good an alliance with them. So why doesn't Pakistan develop products for them? This is a question that has come up, and perhaps you can throw some light on what you think is happening here.
Well, I don't have a particular view on this. I think certainly it's an opportunity. I mean, if you think about the acquisition recently of Cloudways, it demonstrated what is that you can leverage basically local Pakistani talent monetize opportunities internationally. And going back to that question on India, I think that's something to actually be learned. It's what are the key comparative advantage that you have from a technology perspective that you can leverage globally, that then once that it goes through one cycle really provides an ecosystem locally to kind of further catalyze the domestic ecosystem. So certainly I think there's a lot of use cases for the domestic kind of technology ecosystem to support internationally, whether it be Saudi or elsewhere. And you've had the precedent of it obviously with Cloudways recently.
Right. Faisal, your thoughts on it? Faisal, you're muted.
Sorry, I was trying to read the question simultaneously. So I think, look, with a lot of our portfolio companies, what we've advised them is to focus on Pakistan since it's such a big opportunity. But again, if you look at Saudi and the MENA region, a lot of the team and the founding team in most of these companies end up being of Indian or Pakistani origin as well. So generally, there's a lot of it. One thing I've learned is that because of Kareem having so many Pakistanis do feel comfortable landing anywhere in MENA and having a network on the ground because they build businesses there. So I think that's definitely part of it. In fact, a couple of our fintech companies have actually entered MENA, specifically Saudi and the UAE, because they feel those products can scale there. And it's also strategically to tap into Saudi money or UAE money, MENA money, because they're very cash rich and they're able to funnel money to build big products. So Pakistan to me is a naturally, but one thing I forgot to say in the 2030, the way I view the world is that more than likely we are part of MENAP economic zone. So the world will be less nation states. It will be economic zones. And so from a technology footprint, it already looks that way, where it seems like Middle Eastern platforms, Pakistani platforms are effectively going to merge to create a network. And that obviously exists because the gated approach with India. I mean, in an ideal world, it would have been South Asian platforms, but because of the geopolitics, it looks like it's going to be in that direction. So I think, yeah, I mean, in founders that can, in fact, even create holdcos in MENA and have a use case for Pakistan and the Middle East will end up actually raising a lot of money and building some interesting products.
Excellent point. And I think Faisal, interestingly, although there is a MENAP concept, but Indian presence in terms of technology and providing service to technology companies in the MENA region, also UAE, Saudi also, I think, and also specifically the region that I work in, which is East Asian Pacific, is tremendous. One of the development firms that I consult with rather, which is IFC, is actually, outsourcing most of their IT to India. And, we have all our Indian colleagues calling us and helping us real time. And so it's fantastic what technology can do. It can really help you access a market that perhaps was not there before. So even though there is that MENAP thing, but perhaps there may be some ventures which are quite joint between the India-Pakistan space in terms of technology in these kind of neutral, spaces that we talk about.
Absolutely.
So that is something that again, is a possibility that exists. So I think there's one large, 2, 3 more questions. I thought we were saying goodbye a little, maybe 15 minutes ago, but we have another. Will Kian invest in Pakistan in 2022? 21 more days. What is the big concern? Kian, so all these are for you. Do you want me to read them out? What is the biggest concern for Kian about Pakistani tech startups? And how can we reach to Kian and Faisal? So I read them out, so I've done my bit. Now it's over to you.
So, I mean, in 2022, we already have invested, so I'm not rushing for the last 21 days. So we've made 5 investments in Pakistan. As I mentioned earlier in the introduction, we made a hire recently in Pakistan, which is our Saad Hassan, which is our lead in the country. So the intention is to be kind of investing in the country for many more years to come. The biggest concern is not kind of specific to Pakistan, but generally is across the dynamic that we see in the markets that we invest in, is that you have in some cases kind of second or third time founders that have had the experience of what it means to build a sizable business and kind of go through the journey of exiting it. And we see a lot of companies that kind of build a level of traction to, let's say, $1 million, maybe even $2 million in revenue. But to get to build a business of, let's say, 20, 30, 50, even $100 million in revenue requires kind of a different beast of an individual, and the iteration you have to go through to be able to understand what that journey means and that experience entails is an open question. So we really have to bet on the ability for founders to learn and their intellectual honesty to be able to kind of iterate and grow and evolve as the journey of the business develops. So for us, really, it's not an opportunity question, it's a kind of founder question when we're looking to invest. I actually think the question before it is a really interesting one, in the sense that sometimes startups create value, but they miss capturing it. How do founders avoid this trap? And I think this is a really interesting kind of study of the economics of different business models. There are many different business models where they provide kind of just a tremendous amount of value to the consumer, but the business never captures that value. I mean, if you want to take kind of a very traditional example, the airline industry is one. It's one where you could kind of easily say it's transformed the lives of consumers over the past however so many years, but basically it's an industry where we've had the highest rate of bankruptcies because of the nature of the economics of that industry. High variable costs, no pricing power, no brand power, all of these dynamics. And what we see, actually, going back to that point on concerns, is we see a lot of business models where all of a sudden you have 5, 6 companies that arise that get well funded. My bet is that in those industries, it's very difficult to actually have economic power or kind of build a defensible moat over time. The lack of a moat basically means you're giving your economics away, and the end state economics of that are very difficult in an industry. So I would encourage founders, there are sectors and industries where the opportunity is clear, but to really think about how one can build a moat in it to actually capture the economics that actually sit for the business and as a result for investors, because they can get arbitraged away very quickly. So, and this concept of moats is an interesting one. It's not a static one. You're either building one or it's been taken away from you. So I think it's actually one of the most important points to think about when investing and building a business anywhere, but especially in emerging markets or a country like Pakistan.
Thank you, Kian. Thank you for, first of all, thank you for being such a good investor in Pakistan. So everything that is at least clear that, you know, you've had 5 investments and you're going to be here for the long run. And also for the great insights and that you have given about, you know, being able to build value in businesses and those excellent insights. So thank you. I'm sure they're useful for our listeners. And the final question before we wrap up for this session is how I think everyone wants to know how they can reach Faisal and yourself. So, Kian, how can they reach you? And Faisal, how can they reach you?
So, I mean,
I'm actually just going to type my email. I think you should type Saad's email.
Okay, super. So I think so for all the listeners, the audience, you're just please note down you know, the LinkedIn and the emails that are being typed out, and they are the real ones. So don't worry, you will get connected to them. And thank you so much for being such a fantastic audience and giving us those very, very interesting questions. And I believe there are 2, 3, or perhaps more out there, which we've just jotted down, and we'll get back to you on those. I also want to give a very heartfelt and big thank you to Faisal and to Kian. We've learned a lot. I have learned so much from the wonderful conversation that we've had, the insights you've brought to this very rich discussion. And also, I want to also appreciate how candid and honest you've been about all the aspects. And I think that is what the key learnings that we have gotten are going to go a long way. We're very thankful to you, and thank you to the audience, saying good night, good evening, and good morning, good afternoon to everyone, and bye, and thank you again.
Thank you. Pleasure to be here. Thank you. Bye, everyone. Bye.